Something just happened in the silver market, and I need you to hear this clearly. The price you see on the screen and the price paid in real cash markets are drifting apart. And if that gap keeps widening, we're staring at the moment when silver contracts get settled with cash because the metal isn't there. That's the event. That's the trigger. And if it happens, it won't stay inside silver. Because once one guaranteed promise can't perform, every other promise starts to look suspicious. I'm John A.G., and today we're going to connect 4 threads that most people keep separate. The silver delivery risk, the derivatives mountain that sits on top of the real economy, the Japanese-style carry trade unwind that drains liquidity, and the slow-motion retreat from U.S. debt that quietly forces the printing press back into the driver's seat. And as we go, I want you to notice something. Every one of these stories is really the same story. It's the story of confidence. Now, quick favor before we dive deeper. I'm running a campaign to eliminate copycat channels that rip original work, remix it, and then outrank the source. If you value the way I break things down, hit subscribe and comment OG John AG so the algorithm knows who's actually here for the real paper versus physical, where the price is real thing. Also, if you want daily videos, instant updates, posts, and my personal analysis that I don't put on YouTube, I made a WhatsApp channel. It's got premium notes, quick voice updates, and alerts that go out the moment something moves. The join link is in the description, so jump in there after this video. All right, now let's start with exactly what happened. Silver didn't just rise over the past few months. It moved like a market that finally realized it was mispriced for years. But the headline number is not what matters most. What matters is the way the market behaved during the move. Because if you look beneath the chart, you see something more important than a rally. You see stress. The traditional paper venue still tried to control the narrative by printing a price that assumes supply is infinite because paper supply basically is. Meanwhile, cash and carry markets where people actually show up with currency and expect delivery started trading at noticeably higher levels. And once you have 2 prices for one metal, the game changes because the next question becomes unavoidable. Which price is real? Is the real price the one that can be pushed around by contracts that can be created with a keystroke? Or is the real price the one where a buyer can hand over cash and demand bars? This is why I keep telling you the story is shifting from charts to mechanics. Suppression is not new, but suppression only works while the crowd believes paper and metal are interchangeable. The moment that belief cracks, the system doesn't just face volatility, it faces a credibility test. And the credibility test has a very simple pass-fail question. Can the contract perform? Because here's a brutal truth. A contract that can't do what it says it will do is not a discounted asset. It's a broken promise. And broken promises don't get contained. They spread. Let me give you a simple picture of how this usually plays out and why the next delivery window matters so much. Most people don't realize that futures markets have specific months where delivery pressure concentrates. You can trade contracts all year, but when a big delivery month arrives, the conversation changes from what's the price to show me the metal. That's when shorts who normally roll their positions forward have a problem, because rolling only works if the other side agrees to keep playing paper. But if enough buyers stand for delivery, the short side has what failed to deliver actually means to either find physical bars, borrow them, pay a premium to source them, or negotiate a cash settlement. And that's why you'll often hear people point to a spring window like March or April as a stress point, not because someone is guessing, because that's when the machine has to prove it can do what it claims. Now imagine the headline. Exchange announces alternative settlement. It will sound harmless. It will be wrapped in legal language. It will be blamed on logistics or market disruption. And the first wave of the public will shrug because cash settlement sounds normal if you don't understand what you were buying. But the professionals will hear something very different. They will hear the metal wasn't there. And the moment that becomes the whispered truth on trading desks, the entire conversation around paper commodities changes. Because commodity derivatives don't exist in isolation. They are collateral. They are hedges. They sit inside portfolios that also hold stocks, bonds, credit, and currency positions. So if one piece of the derivative universe loses credibility, margins change everywhere. And margin is where panic lives. When confidence cracks, exchanges and brokers demand more collateral. When they demand more collateral, leverage players have to raise cash fast. And when they have to raise cash fast, they sell whatever they can, not whatever they want. That's how a problem in silver can force selling in tech stocks, junk bonds, and even supposedly safe government debt. It's not because those assets are directly related to silver, it's because they're connected through leverage. This is why I keep saying the reset doesn't start where you expect it. It starts where the system is weakest. Now, one more layer, because this is the part most people miss. The biggest slice of the derivatives world isn't even commodities, it's interest rates. Interest rate swaps, futures, options, and structured products are a huge portion of the entire pile. That means when bond yields move violently, the derivative machine starts groaning, and that brings us right back to the carry trade and to Japan. When long-term yields climb after decades of near-zero policy, the pressure is not linear. A cash settlement, why it changes everything, small rise in yield can create a big loss in price. And in leverage trades, small losses become forced liquidations. So when you see yield spike, it isn't just a headline. It can be a signal that the cheap money era is snapping. And if the cheap money era snaps at the same time that a commodity delivery system is questioned, you get a double shock. Funding stress and trust stress. That's the kind of mix that turns markets into events. Now you might be thinking, but the system has survived so many scares. True. And that's because it usually has one thing left to deploy. Confidence theater. They tell you everything is fine. They tell you supply is adequate. They tell you the market is orderly. And as long as most people believe it, it stays orderly. But confidence theater only works until it collides with a hard constraint. And physical shortages are hard constraints. You can't print bars, you can't talk your way into inventory, you can't create metal with a press conference. So the moment physical reality contradicts paper promises, the narrative loses power. Now let's zoom into the strategic angle again, because this is where the retail investor gets blindsided. If you're buying silver as a store of value, you're thinking like a saver. But the largest buyers are thinking like operators. They're thinking like, if we don't secure supply, our production line stalls. And a stalled production line is more expensive than paying a premium for metal. So strategic buyers will pay up. They'll pay up quietly. They'll pay up through contracts you'll never see. And that's how the retail market can be drained without any dramatic moment on the chart. A lot of people learn this lesson in other markets. When energy is tight, consumers don't get first priority. When food supply is tight, export rules change. When a material becomes critical, governments don't hold a vote to ask permission. They act. So if silver is viewed as critical, the Great Lockout isn't science fiction. It's a policy pathway. And what makes it dangerous is timing. It can happen fast with no warning because it only takes a few large decisions to redirect flow. Now, I want to throw in a viewer-style question here because I know it's in your head. A lot of you are asking, if the paper system breaks, will the price crash first? And the honest answer is, you can see violent moves in both directions. In the early phase of a crisis, forced selling can hit everything, even metals, because people sell what they can to meet margin. That can create sharp dips that feel like the thesis is wrong. But if the crisis is rooted in trust and scarcity, those dips, how silver stress spreads into derivatives, can be the last chance to get real metal before the door closes. That's why the psychology is so brutal. The market tries to shake you out right before the fundamentals take over. Now, think about the bond math. Debt grows daily. Deficits persist. Auctions continue. If marginal foreign demand falls, then domestic demand must rise. If domestic demand can't rise enough at current yields, yields must rise to attract buyers. If yields rise too far, the interest burden grows. And when the interest burden grows, the political temptation to suppress yields grows. That's the trap. Suppress yields and you risk the currency. Let yields rise and you risk the system. Either way, hard assets look more attractive. Now, this is the part that gets people arguing about hyperinflation versus deflation. And I'm going to say it the way it actually plays out. You can have both. You can have currency inflation at the same time as asset deflation. You can have prices rising at the grocery store while asset bubbles pop. It depends on what is being delivered and what is being printed. And the measuring stick matters. If you measure in dollars, you see one story. If you measure in gold or silver, you see another. That's why some people are shocked when they price big-ticket items in ounces instead of in currency. They realize the expensive world is sometimes a currency illusion. Now let's talk about the human side again, because charts don't capture what matters most. If you're living in a fragile system, your best investment is optionality. Optionality means you can adapt when conditions change. And optionality isn't just money, it's skills, it's relationships, it's stored essentials. It's the ability to say, I don't need the system tomorrow, because the system gets dangerous when it can't meet needs. That's why I talk about basics. If the grid is unstable, can you keep light? If water is compromised, can you filter it? If transport is disrupted, do you have a buffer? If you lose income temporarily, do you have runway? This isn't doom talk. This is adult planning. And the people who plan in calm times don't panic in stress times. Now, let me weave the miners back in, because there's another angle people don't consider. In a true resource repricing, governments can get involved. They can change taxes, they can change royalties, they can change rules, they can declare resources strategic. So when you own a miner, you're not just owning geology, you're owning jurisdiction risk too. That's why diversification matters. That's why position sizing matters. And that's why holding at least some physical outside the system matters. Because physical doesn't need permission to exist. Now, one more community moment, and then we're going to land the plane. If you've had success in the past year, Whether it's in business, investing, or just getting your life in order, drop a short note in the comments. Tell people what worked for you. The comment section can be a place where we build each other up, not just a place where we argue. And if liquidity plus margin calls, the domino effect you're still watching right now, that tells me you care about understanding what's happening, not just being entertained. So, do me one more favor. Check the description, join the WhatsApp channel, and make sure you're subscribed, because the next phase of this story won't give you a polite warning, it will hit fast. Now let's return to that final cliffhanger, and I want you to feel the weight of it. If silver delivery fails and cash settlement becomes the precedent, the world learns that paper is optional. And once paper is optional, the only that isn't optional is the real thing. So the question isn't whether silver is up or down tomorrow. The question is, when the system is forced to choose, do they protect the paper market's reputation, or do they protect the real economy's access to strategic metal? Because whichever side they choose, the other side will react. And that reaction is where the real repricing begins. Let me bring it back to the beginning again, because this is the part you should keep in your head while everyone else gets distracted by noise. If a contract says deliver silver and instead you get cash, then you didn't buy silver, you bought an IOU. And if the IOU gets paid back in a different form than promised, everyone starts asking, what exactly am I holding? That's why delivery matters more than price. Now, the reason silver is such a dangerous pressure point is because silver sits in two worlds at the same time. It's a monetary metal, which means it competes with confidence in currency. But it's also an industrial metal, which means it competes with the physical needs of the real economy. That's the trap for the paper system. Gold can be hoarded and recirculated because much of it is still above ground in bars and jewelry. Silver gets consumed. Silver gets dispersed. Silver gets lost in tiny amounts across products, and those amounts add up. So when demand tightens, silver doesn't have a huge above-ground pile that can magically refill the shelves at the snap of a finger. That's why in silver, the physical side can overpower the paper side without needing a miracle. Now, some people still say, okay, but who cares? It's just silver. And I want you to remember this line. In modern finance, it's never just one market, because silver sits inside the derivatives machine, and the derivatives machine is the real monster here. Most people think derivatives are some side casino, a playground for professionals with 6 monitors, but derivatives are not the sideshow. In a financialized world, derivatives are the operating system. They wrap around interest rates, currencies, credit, commodities, equities, and even volatility itself. They are the plumbing. And here's the part that should make you sit up straight. The size of that plumbing, even in conservative terms, is multiple times larger than the value of the real assets it's supposed to reference. Meaning we've built an enormous structure of promises on top of a smaller pile of real stuff. That's the why gold and other commodities get pulled and tail wagging the dog. It's like writing insurance policies on a house, then writing insurance policies on the insurance policies, then writing bets on whether those policies will be paid. Everything looks stable until one claim can't be honored. And the moment one claim can't be honored, everyone rushes to check the fine print on their own claim. This is why one delivery failure can ripple outward, because it's not the metal, it's the trust. If silver is cash settled due to emergency conditions or some version of force majeure, the market learns something dangerous. Performance is optional. And if performance is optional in silver, traders won't stop at silver. They will start asking, is gold next? Then is copper next? Then is energy next? Then is food next? And the second that question becomes mainstream, risk gets repriced everywhere. Now here's the part I want you to really think about. When trust breaks, it doesn't break smoothly. It breaks all at once because trust isn't a dial, it's a light switch. You believe the system works until you don't. And in that moment, people stop chasing returns and start chasing certainty. They start chasing collateral. They start chasing anything that can't be created in unlimited quantities. Now, if that's the first thread, here's the second one, and it's happening at the same time. The carry trade unwind. For years, one of the easiest global trades was borrowing in a currency with extremely low interest rates and deploying that money into higher yielding assets elsewhere. When funding costs are near zero, leverage looks harmless. But when rates rise, leverage turns into a trap. And when that trap snaps, it doesn't just hurt one fund. It pulls liquidity out of everything, because that borrowed capital didn't sit idle. It flowed into government bonds. It flowed into corporate credit. It flowed into equities. It flowed into risk. And in some cases, it flowed into strategies that leaned on commodities through paper selling. So what happens when the unwind accelerates? It does two things at once. It removes support from traditional assets because positions that were propped up by cheap borrowing have to be reduced. That means selling. And it forces closure of certain short positions because those positions become too expensive to carry or too risky to maintain. That means buying. This is why the unwind can be chaotic. One side of the market is being liquidated, another side is being squeezed. And those forces don't cancel out, they collide. Now, in the carry trade story, One place matters more than most people realize: Japan. When long-term yields move higher in a country that spent decades living near zero, it's not a small detail. It's a funding shock. Because even small increases in funding costs can crush trades that were designed around almost free money. And when you combine rising yields with a shaky currency relationship, the squeeze gets worse. Borrowers who funded positions in cheap currency now face two problems. Their borrowing costs rise, and repaying can signals to monitor next pressure points get harder if the exchange rate moves against them. So they do what they always do in a funding squeeze. They unwind, they sell what they bought, they buy back what they sold, and they run for liquidity. Now look at what that means for metals. If some of the pressure on metals came from short selling in paper venues, that an unwind forces buying into those same venues. And forced buying is the worst enemy of a thin market, especially a thin market that might not have the physical backing to calm things down. So silver isn't just dealing with demand, it's dealing with the possibility of forced demand. And forced demand is what turns a steady bull market into a violent repricing. Now, thread number 3, de-dollarization, not as a slogan, as a process. You don't need the dollar to vanish for this to matter. You only need the marginal buyer of US debt to step back. Because the US government runs on borrowing, it spends more than it collects. So it issues bonds, and those bonds must be bought. If foreign buyers reduce participation over time, the funding burden shifts inward. And when the funding burden shifts inward, the central bank becomes more important. And when the central bank becomes more important, monetization becomes more likely. That's not a political statement, it's arithmetic. If you want a simple picture, imagine a restaurant that keeps raising its expenses and keeps promising it'll make it up later. If fewer customers show up, the owner still has to pay the bills. So the owner either cuts spending or finds a way to create money. And governments historically choose the path that keeps the lights on. Now, add this to the trust problem we already discussed. If markets see stress in deliveries and they see rising monetization risk, they stop thinking in terms of growth. They start thinking in terms of preservation. And that shift is what drives hard assets. Now, thread number 4, and this is where the story gets dark fast, the strategic lockout. Years ago, there was a retail movement that tried to squeeze silver by buying coins and bars. It made noise. It created a moment, but it didn't fully break the system because it was mostly small buyers. This time, the pressure looks different, because the big buyers aren't just stackers. They're institutions, manufacturers, and potentially states that view silver as a strategic input. And when strategic buyers show up, they don't care about the premium. They care about continuity of supply. They don't want to win a trade. They want to keep factories running, so they do what retail can't do. They sign supply contracts. They prepay. They buy streams. They buy production. They buy mines. And sometimes they restrict exports or redirect metal internally. And here's the most important part. This can happen, practical takeaways, risk awareness plus positioning, quietly. No press conference, no warning. One day the market is tight. The next day the retail market is effectively closed because the available inventory has already been spoken for. That's why people who say it can't happen are underestimating how fast a strategic shortage turns into a policy choice. Now, I want to pause and ask you two things because your answers matter. First, if the system has to choose between keeping retail happy and keeping national supply chains running, who do you think it's priority? Second, if a major exchange announces cash settlement instead of metal, do you think that calms the public or does it light a fire under every other commodity? Drop your answer in the comments because I read them and I want to know how you're thinking. Now, before we continue, let me do a quick creative shout out right here. If you're into silver and you want to hear actual silver-related success stories, like real people explaining what they did, what worked, and how they protected themselves, there's a separate channel linked in the description that focuses on those wins and strategies. If you want that kind of motivation alongside the analysis, tap the link and subscribe there too. All right, now let's talk about what you do with all of this, because information is useless if it doesn't translate into a plan. The first mistake people make is thinking they can trade a structural reset, like it's a normal market cycle. This isn't a normal market cycle. In a normal cycle, you can sell, wait for a dip, and buy back in. In a confidence event, the dip might not come in the form you expect. It might come as a gap higher, or it might come as a market that simply doesn't offer product at any price you recognize. This is why some experienced metals people say this is the rally you don't sell. Not because you'll never take profit, but because the risk of being out when the market locks up is higher than the satisfaction of timing one perfect pullback. Now, when it comes to gold versus silver, the debate is endless, but the structure is simple. Gold tends to be the reserve asset. Silver tends to be the volatility amplifier. So a lot of people want a final summary and what comes next blend, and the blend often becomes a ratio strategy. When the gold to silver ratio is very high, it suggests silver is cheap relative to gold. When the ratio compresses, silver has usually outperformed. So one strategy is to build more silver when the ratio is stretched, then gradually convert portions into gold as the ratio falls. Not all at once, in steps. Because steps remove emotion, you can pick levels that make sense to you and execute a portion at each level. That way, you're not betting your future on one dramatic decision. Now, let's address the elephant in the room. Paper exposure, exchange trader products, brokerage claims, mining shares. These can all have a place, but they are not the same as holding the thing itself. A claim is only as good as the system that enforces it. And when confidence is under pressure, enforcement becomes political. So understand what you own. In a stress event, I own and I'm owed are not interchangeable. Now, miners. Mining stocks can be explosive in a bull market because they're leveraged to the price of the metal and to the market's willingness to value resources in the ground. There's a reason mining companies were historically valued by what they had underground, not just by today's production. When the world becomes resource conscious, in the ground starts to matter again. Now let me tell you a story that illustrates this without naming anyone. There's a gold operation in East Africa that spent years bootstrapping its build-out, not with endless dilution, not with fairy tale projections, with actual cash flow and careful expansion. They built plant and infrastructure step by step, and the plan, if execution holds, is to scale toward roughly 60,000 ounces of annual gold production. Now, do that math in your head. At elevated gold prices, that's serious revenue. That's the kind of cash flow that allows drilling to accelerate. And drilling is where the real upside often hides, because in the past year or two, this operation identified additional zones with markers similar to the main deposit, and those zones could materially expand the resource. When prices rise, ounces that were previously uneconomic can also become countable as reserves, meaning the same rock can suddenly be valued as more. This is why some investors focus on land packages and geology, not just on monthly production numbers, because the big payday isn't always the dividend. Sometimes it's the revaluation. When the market decides to value gold in the ground again, the companies holding the right ground can reprick violently. Now, I'm saying this carefully. None of this means you throw all your money into miners. It means you understand why miners can go from ignored to essential in a hurry. And it means you consider custody because your broker is also a counterparty. Now, let's shift to a debate that confuses almost everyone: inflation versus deflation. People argue like it's a single outcome. It's not. It depends on your measuring stick. If you measure everything in currency that is being expanded, you'll see prices rise. If you measure in a hard asset, you can see the opposite. Here's a simple example. Think of durable goods like cars. Over long spans, the sticker price in currency can rise dramatically, but measured in gold, the cost can fall. That's not because the car got cheaper, it's because the measuring stick changed. So you can have a world where food and energy inflate in currency terms, while certain assets deflate relative to hard money. That's why the phrase that keeps coming true is this: inflation in the things you need, deflation in the things you own. And that's exactly why positioning matters. Now I want to bring this back to real life again. What should a normal person do if they believe we're heading into a confidence-driven reset? First, accept responsibility. No one will protect your purchasing power for you, not your employer, not your pension administrator, not a politician, not a banker. You have to build your own resilience. Second, think beyond finance. If the system gets strained, basics matter. Food, water, energy, security, and yes, skills. 100 years ago, more people had practical skills that made them less dependent on the grid and the store. Today, many people live on a just-in-time lifestyle. They buy what they need every day or two. That's comfortable in stable times. It's fragile in stress times. So ask yourself, if the supply chain hiccups, what changes in your life within 72 hours? Because that's a useful test. Now, you may not be able to move, but location still matters. Dense cities concentrate. People and dependency. When services get strained, density turns into pressure, and pressure turns into conflict. So even if you stay where you are, think about how you reduce dependency, how you store basics, how you create options, how you build community with people you trust. Now, speaking of community, let me add two quick things, and then we'll wrap with the big cliffhanger. If you're doing well right now, if you've had a breakthrough, a win, or a business success, share it in the comments. You have no idea how much it helps other people to hear real wins from real viewers. By the time you're watching this, a members-only video should already be live. It's a single place where I'm compiling the newest updates and giving deeper, more detailed analysis than I can do publicly. If you want the full timeline, the extra context, and the why behind my calls, join the membership and watch that members-only upload. Premium members get more in-depth breakdowns, and it also shows me who is really following closely. All right, now let's stitch the whole thing together. A silver delivery failure is not about silver, it's about whether a contract is a promise or a suggestion. If it's a suggestion, then trust becomes scarce. When trust becomes scarce, collateral becomes king. When collateral becomes king, leverage becomes expensive. When leverage becomes expensive, the carry trade unwind accelerates. When the unwind accelerates, traditional assets lose their borrowed bid. And at the same time, short positions in tight markets become forced buys. That's how you get violent repricing. Now add the bond funding issue. If fewer external buyers show up for debt issuance, internal monetization becomes more likely. If monetization becomes more likely, currency debasement becomes a bigger risk. And when currency debasement becomes a bigger risk, hard assets look less like investments and more like lifeboats. So this is not just a bull thesis, it's a trust thesis. And trust can break suddenly. Which brings us to the most important cliffhanger of this entire video. If the system has to choose between protecting its paper promises and protecting access to real strategic metal, which one do you think it will sacrifice first? Because that choice will decide whether the next chapter looks like a normal rally or the kind of reset that people talk about for decades. If you found this useful, subscribe right now. Drop OG John AG in the comments if you want me to keep pushing this campaign against copycats. And join the WhatsApp channel in the description so you don't miss the instant voice updates and the fast alerts when the next domino falls. And remember, the biggest moves don't announce themselves with fireworks. They announce themselves with shortages, then with excuses, then with policy. And by the time the headlines catch up, the doors are already closing, right?